When it comes to trading options, it is all about statistics and it is all about probabilities. And today I'm going to be joined by a special guest to talk about those two issues today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest. All will know who trade options that one of the most important things is understanding how the underlying assets can behave. This is how we establish the probability of profit and whether we expect to make any profit. And today I'm going to be talking to an expert who studies these specific issues. I'm joined today from Italy and slightly under the weather, so hopefully we're going to get through this, by Domenico Dall'Olio. He is an adjunct professor in Italy where he talks about some of these issues, and he's also with Trade AI, which is a technology platform that specifically focuses on these types of issues. And we're going to walk through a couple of trades together, how you actually use these approaches and techniques to identify trades. So, Domenico, welcome. Good to have you.
Thank you. Thank you, Mike. It's nice to be here.
So let's get a little bit of a background first on your approach here. So how long have you been working with Trade AI on this approach?
Okay, I've been working with this platform since 2017, and I've seen all the evolutions of this platform and the new functionalities and the changes in the features. And I can tell you, it's a very intriguing methodology, very different from all the others, all the other platforms available in the market, because it basically starts from the assumption that any model, being just a model, is just a description of reality, which could be correct or not. So the idea is that if you can only rely on one model, you may have a problem. But if you have several different models, and each of which is giving you basically the same description of some phenomenon, then you could say that it's like going to 10 different doctors because you have a pain in your arm, just to say, and you get 10 equal diagnoses. So you can say, that's the problem. Okay, I know how to fix it. That's the same idea. And here we have 10 different probabilistic models, some of which are pretty original, pretty innovative, And when you observe a phenomenon, which in this case is, I don't know, I have an expectation on Meta, which is one of the two stocks we're going to analyze today, that the stock is not going to drop below some threshold. And anytime you take this assumption, you have, the main problem is, am I doing it right or wrong? What are the odds in my favor? What are the odds against me? And most of the people in the markets usually rely on implied volatility, which basically means to rely on the normal distribution of returns. And in this case, we start from the normal distribution of returns, and we add 9 different points of view on the same phenomenon in order to try and get a multi-angle description of the same idea. And in this case, when you get to this, to the calculation of the probabilities based on all these models, and you have very different readings in the probabilities. Some says 90, some say 70, some say 100, some say 85. You have a problem. But when you have all the 10 probabilistic models saying 92, 93, 95, 97, 98, then what you can say is that for sure you will never be 100% sure that you are doing it right, but the probabilities are really on your side. So this is the philosophy behind the platform, the Trade AI platform.
Now, just to give a little bit of a sense to the viewer of the kinds of options trades that you engage in and how you're using the platform, I mean, would you describe yourself as a directional trader, as a volatility trader? In other words, you're going to be getting long volatility or short volatility, or are you basically just looking, you have a fairly straightforward options approach, but you use this more sophisticated technique to identify strikes and expirations? So what is the most common options trade that you do and that you advocate?
Well, actually, I use some very simple trading techniques. 95% of my trading is short volatility, and it's basically short puts on stocks that I feel comfortable taking the risk of being assigned if the price drops below the strike. So my first filter is always on the fundamental side, on the fundamental point of view. So I basically use, a screener in order to select a basket of stocks that I'd rather trade on, and then I match my list with the list of trades suggested by the trade AI. And every time you have a correspondence between the two lists, as it happened yesterday with Meta and Qualcomm, the two stocks we're going to talk about today, I study trades on the stocks that match my criteria. But the first criteria is always the fundamental side. I want a stock that have earnings, positive earnings. I'd rather trade stocks having a return on equity at least 10%. I usually trade stocks having prices lower than some thresholds because I'd rather, diversify on a basket of stocks all below some price threshold than to focus on just a low number of stocks. And then I look for good trades on Trade AI, all having probabilities above 90%. That's basically my way of trading.
So the way I'm taking, my takeaway from this is that although you're using a pretty sophisticated statistical approach to option selection, that this is actually a strategy that pretty much any investor who trades options could implement. Then is that a safe way to describe it?
Yeah, absolutely.
So I think then in that case, maybe we can walk through a couple of examples together. And you just mentioned that you had two, Meta and Qualcomm. Maybe we'll start with Meta. Meta was really in the news today because I understand that their super AI group just managed to poach a couple folks from Apple. As all will know, Mark Zuckerberg is very actively trying to make sure that Meta is competitive in the AI space and is willing to apparently give people contracts that are worth as much as $1 billion to come over to his organization. And apparently they had recruited a few people from Apple, and my understanding is from the news this morning that they grabbed a couple more. But yeah, let's go through that process. I think we probably don't need to get too deeply into the fundamentals for Meta. I'm happy to discuss those a little bit later if anybody might have some questions about them. But in the meantime, let's start talking about your approach on the option selection. So what's this first table that we're taking a look at here?
Okay.
This is the earnings history table, it looks like.
Yeah. Okay. I was expecting to see it on the screen, but I can't see it right now.
We need to make sure that you have your return pinned. What are you looking at, me or yourself?
Yeah,
or
I'm still
like
seeing
that?
you, Mike.
Okay. I don't know if you can, one thing we can try to do is possibly if you can, in the upper right-hand corner, you're going to see an ellipsis of the screen that you want if you're looking at the Zoom screen that has the stuff that you want. So you might need to shrink that and then hit that ellipsis. And then you want to right-click on that. And you want to say pin to second screen and then expand it again. And then you'll actually see a program return.
Okay, I got it. Okay, this is, as we can see in the top part of the image, it's the earning history report. This is a table that shows the last 10 quarters of earnings of the stock Meta in this case. And you might notice immediately that there could be a mistake in the first line, because you see in the first and the second line you have the same expiration date and the same expiration price. Indeed, the expiration price in the first line is 572.21, the one you can see in the third column, start price. Anyway, what this table shows us is that if we focus on the central columns, the 80% probability price on expiration stay between low and upper band. If you look carefully, what you will see is that the price on expiration has almost always been included between the lower and upper bands. And these two bands, the lower and the upper, are calculated by one of the probabilistic models of the Trade AI platform, based on basically the historical returns only in the periods of earnings. So it's conditional historical return distribution, we could call it this way. It's a historical distribution limited to the periods of earnings. And with an 80% probability, we have a lower and an upper band. And as we can see, if you look carefully, the expiration price has almost always been included within those bands, meaning that in the moment that you have this, we can call it trajectory chart, which we're going to see quite soon. You can use those bands in order to set a put strike and or a call strike for short selling positions, or vertical spreads, or whatever you feel comfortable with. So you have some price thresholds to use in order to set your trades, which is basically what I usually do. I look for the trajectory chart. I set the strike prices for my naked puts, and then I go look for those naked puts and inspect whether there is a good expected return or not. So
if I could just interject here and just make sure that I'm understanding what you're saying correctly. So basically, what this is giving me is some historical ranges and probabilities that are based specifically on the stock price's behavior during earnings periods.
Exactly.
So this is all earnings context. So I'm looking ahead to earnings, but I'm also looking back at past earnings periods specifically to understand the stock's behavior and to establish what the probabilities might be.
Exactly.
And you mentioned an 80% probability. So basically, the upper band would represent an 80% probability that call, if I, let's say, sold a covered call or sold a naked call, whatever, an 80% probability that call would expire worthless. Is that the idea? Or?
Exactly.
Okay.
That's
and in your work, have you found that an 80% probability translates to, suitable returns? So that's a question that a lot of people who engage in these types of credit trades might sometimes ask. So for example, there are certain platforms that love selling, we'll call it 20 delta strangles, right? So if you sell a 20 delta strangle, that has only a 60% probability of expiring worthless. And whether or not that actually translates to good risk-adjusted rates of return. But in your experience, 80% has proven to be a good risk-adjusted rate of return. So you can find enough trading opportunities.
Absolutely. I conducted a deep study on several stocks, several American stocks. And what I found out is that when all the probabilistic models of the Trade AI platform are at least 75%, so 75, you do not need it to be 80. If it's just 75%, the empirical rate of success is, if I'm not mistaken, 86%. So, this is the strength of using several different probabilistic models that combine together give you the same reading of the same phenomenon. And I can tell you that it works.
Okay. Well, let's maybe we can go to this next slide, which looks like a histogram or a probability distribution. Actually, well, the histogram is not a probability distribution; it's an actual distribution.
Yeah.
And then and then overlaid against that, we have a probability distribution. Why don't you tell us what we're looking at here?
Yeah, sure.
Important?
This is the first idea the TradeAI platform is based on, which is the comparison between the theoretical distribution of returns, which is based on the normal distribution, and the one we could call the real historical probability distribution chart, which is the green histogram. Okay, and in this case, it is based on a 5 years observation of returns of the stock meta, and as we can see, the normal distribution is quite a good approximation in this case of the real behavior of the stock, which not always happens. Sometimes it does, sometimes it doesn't. And when it doesn't, sometimes you have significant differences between the two models. But one thing that captures the eye immediately here is if you look at the tails of the distribution, there's plenty of events that, according to the theoretical model, shouldn't even exist. And that tells you that you have to be very careful in short selling options, both on the put and call side on Meta, because the events that go into the tail of the distribution are much more frequent than you could expect. But nevertheless, the central events, the events that get very close to the mean, are significantly higher than what the model suggests, meaning that the stock tends to move not too much most of the time, much more than what the theoretical model suggests. This is the first step that Vlad Furman, the inventor, the creator of the TradeAI platform, took in order to try and provide different points of view on the same phenomenon. And the historical distribution of returns is the first step, of course, just the first step, which brings together pros and cons, of course.
Yeah, I mean, one of the things I want people who are looking at this to pay attention to, because this is a really important concept when it comes to options trading. And, for those viewers who may have studied statistics, and, we're talking about distributions that are normal or not and their respective shapes. One of the things that we often observe about stock prices, so it should be said that different underlying assets, and predominantly what Domenico and I talk about most of the time, are U.S. publicly traded equities. So we're usually talking about those things. It should be said that different underlying assets can have very different characteristics in terms of what their distributions look like. But the most common distribution for publicly traded equities in the United States, and for equities generally, is that they are leptokurtic. So what leptokurtic means is that, rather than having a normal distribution, you'll get one that will be a little bit taller and thinner around the mean, and it will have fatter tails, meaning that the really low probability events actually occur more frequently than a normal distribution would suggest that they would.
Exactly.
That very small moves tend to occur with greater frequency than a normal distribution would suggest, and that where it's grabbing, essentially where you're squeezing the balloon of events, if you will, is sort of in that middle area. So, maybe with, one standard deviation higher or lower, that those events might actually happen with slightly less frequency. And I think this particular graphic illustrates this very well. You can see that it is a little bit taller around the mean, and you can definitely see that there are more events around the tails of the distribution than a normal distribution would predict. What's this next chart that you or table that you have for us?
I think the options overview report. Yeah. This is a very interesting table because it shows for different expirations. Here we have just 5, the closest ones. We have on both the calls and the put side several parameters, of which a couple are highlighted here. You can see the open interest, and the average strike. The average strike is basically a weighted average of the strike prices using the open interest as weights. This way, what you get is basically the center of gravity of all the positions active in the markets on both the call and the put side, which gives you basically an idea of the price range that very likely the price of the stock is going to move within. So what we could expect is that very likely the price of Meta on the expiration of August the 1st, which is this Friday, the day after tomorrow, will be between 667.52, the average strike of the puts, and 761.39, which is the average strike of the calls. Because that's what we could expect the operators will try and do in order to, maximize their gains.
So there's sort of you have a little bit of a Max Payne Gex element built into this, I guess.
Yeah.
I know that there are a lot of people that take a look at that. I guess one way that I would like to think about this, and maybe the way I would characterize it. I mean, my background is in options market making and volatility trading, so I know that a lot of people who are watching who that's not their background, that there's often this notion that dealers have an objective about the price of the underlying asset. Oftentimes they're thinking that maybe they're trying to maximize their own profit by minimizing the profit of the options market's retail participants. In fact, it doesn't really work like that, because the dealers don't really think very much about the other side of the trade. But there is something that is important in this, which is that there are certain magnetic effects that take place where large pools of open interest in options take place.
Yeah, it's
and
true.
without getting too wonky about it, we do care whether there's a lot of open interest for a couple of reasons. One is that it sort of reflects the wisdom of crowds, right? So I don't know if anybody has read that book. There was a famous book. It's a concept that goes back about 100 years, which is that if you have a poll of a large group of people about an unknown, that very often that the best average guess of a huge group of participants will come closer to estimating an unknown than even a best expert would be able to do on their own. And so if you have a stock or any underlying asset with a lot of open interest, it sort of means that there's a lot of people who are being polled about their beliefs in how the underlying might behave. And then, of course, because dealers have to hedge their volatility exposure, and that exposure is larger where there's large pools of open interest, you can get interesting effects. So, for example, it's not uncommon to see underlying assets pin, right? So what pinning means is that at expiration, the underlying asset will gravitate towards a strike with significant open interest in it. And there's a really good reason for this. If dealers are long a lot of premium, they have to buy the underlying asset to hedge that when it goes below the strike,
Yeah.
and they have to sell it when it goes above. And as expiration approaches, that effect, which we call gamma, it's the second derivative, increases. In fact, it actually goes almost theoretically to infinity. And what that forces is that oftentimes you'll start to see it gravitate towards a strike because dealers are buying it below the strike and selling it above the strike. And as the more that happens, the more it gets sort of compressed towards the strike. It's not any... People shouldn't think of this as a conspiracy. That's why I've always found it interesting when they say Max Payne, as if the dealers were trying to inflict Max Payne on investors. They're not doing that. They're not even thinking about them.
I've read a lot about it.
All they're doing is hedge. Yeah, all they're doing is hedging. But it does mean, and this is, I think, the point you're making, that when there is significant open interest, we should care about it.
Yeah.
That's the short version. If there's a lot of open interest, we should care that there is, and we should care where it is. And this is an interesting approach, because what you're doing effectively is distilling all of this open interest across all of these different strikes and then weighting it so that you can sort of generalize and come up with a number and say, okay, well, if there's open interest across a host, Meta has a lot of call strikes and a lot of put strikes,
Yeah.
but you're basically saying, okay, these ones have the biggest open interest, and so we're going to weight those strikes more heavily, and then you can come up with a number to just sort of get a general sense, and that's the approach you're looking for here, right?
Yeah, by the way, as we will see later, when we are going to see the trajectory chart, the probability gives us completely another story about the extremes of the potential move of Meta due to the earnings released tonight. So
Yeah, well, let's take a look at this next graphic that you have for us.
yeah,
This is
this is
kind of an
very
interesting one.
interesting.
This,
Yeah, the
mm-hmm.
option sentiment rate. The
Yeah,
option sentiment rate, basically, here we have histograms colored, ranging from strong red to strong green. Strong red is strongly negative, and strong green is strongly positive. And basically, you could read the what we call the option sentiment rate, depending on two main variables: the volatility and the volumes. The volumes, the open interests, and other parameters. Maybe we will get into these topics in another. In another moment, maybe not today. Anyway, the
mm-hmm.
option sentiment based on the volatility just compares the volatility of puts and the volatility of calls. It's very straightforward. You make the ratio between the average volatility of puts and the average volatility of calls, and when it is very close to one, let's say between 0.95 and 1.05, as in this case, if I'm not mistaken, the value, the first line in the pop-up is one. Could it be?
Mm-hmm. Yep.
Yeah, one. It means that the volatility of puts and the volatility of calls is the same, which in turn means that the market is not expecting or is not hoping for significant moves of the underlying in the next 2 weeks, because this is on a 2 weeks basis. So we could use it as a measure of the expectation of strong movements or not, basically.
And just this is kind of another way to think about skewness, is it not? I mean, you're looking at
Yeah.
the relationship between implied volatility of upside calls and implied volatility of downside puts. But
Yeah.
in this case, are you also comparing that to the stock's own history so that you have sort of some context to whether or not it has become more bullish or more bearish in terms
No,
of its history? Is that part of what's going on here, or is this just sort of an absolute metric that has it has value on its own without even taking a look at the options history?
as far as I know, it's just an absolute metric. It's just the current values of put implied volatility ratio and call implied volatility ratio.
Mm-hmm. Okay, so what is this next? So you can use this then to identify an option strategy.
Yeah.
And in this case, because the numbers that you just gave us were, if I could call it this, would we characterize that as fairly neutral then? A value of one is fairly neutral in terms of bullishness or bearishness. Is
Yeah,
that right?
this is the evaluation. If you look at the bottom of the picture, that blue button, analyze trade.
Mm-hmm.
When you select a trade based on basically the option chain that you have in the upper part of the picture, and then you ask the platform, the Trade AI platform, to analyze the trade, it returns the 10 different probabilistic readings, which you can read in the lower table. And in this case, I analyze the short strangle based on put 625 and call 810, which, as we will see, I think in the next picture, are the two extremes based on the trajectory chart. Okay,
Mm-hmm.
so significantly different from the center of gravity coming from the previous table we were looking at. So here, combining these two options, the short 625 put and the short 810 call, you have a credit of $3.80 per share, which basically is lower than the one you could get because the one we can see here is the call. You see the last line of the chain is the call 810, and as you can see there, there's a bid 145 and an ask 165. And for precautionary reasons, the platform takes the bid prices in evaluating the probability readings of the trade. So maybe we could get, yeah, I don't know, 10 cents more if we could hit the mid price on the call trade, and maybe something alike with the put. So maybe the real credit is above 380. Anyway, the probability of profit, which you can read in the table, in the lower table, is actually the probability of not losing, meaning that it's the probability of not getting below or above the break-even points, not the strike price, not the short strikes. So as you can see, according to the normal distribution, we have 100% probability of not losing. Okay. And then we have all the other readings, which maybe we will speak about in future videos. The short historical, the short stress test, the long historical, long stress test, EV, NSV, RSI, stochastic, and PPO, and the earning probability. All these readings give us a different point of view on the same phenomenon. And as you can see, the only value below 90% is the earning probability, which is related to the conditional distribution of returns limited to the periods of the earnings, okay, which anyway is 85, which is a very good reading, you know.
Okay, so I think we have a good sense of these concepts, and so I guess the point you're making is that when the system is establishing these probabilities, it's basically taking the worst case based on a snapshot of options prices at that time to do its calculations. So it's assuming that you're going to execute an option sale on the bid or an options purchase on the offer, on the ask.
Yeah.
But of course, especially when, this is always the case, I strongly encourage people to use limit orders, and preferably marketable limit orders, but there's circumstances where it's not terribly important. If you're trading SPY options, for example, SPY options are typically very tight on bid ask, and you're probably not going to improve your execution very much. Meta has actually reasonably tight option spreads, but as a general rule, I think it's always advisable to try to improve your execution price when the bid-ask spread is more than a couple of cents. And even when it is only a couple of cents, if you're going to execute an order, why not use a marketable limit order rather than just a market order, just in the very slim case that something strange happens while you're firing an order in and markets go wide or wobbly. And what I mean by that is, if in the case of this strangle, let's say you're using a complex order, you put in a sale, and you were perfectly happy with that, and so you weren't going to try to work something in the middle and try to get $3.90, $4, or whatever it is, that at the very least you put in a limit that is the bid price, or if you were happy to get even a nickel below it, that price. That way, if something strange happens while the order is being fired in, you don't get any really nasty surprises. So now that we've sort of talked at a high level about these concepts, why don't we talk about this, what I'm calling the expected trading range and what you're calling a price trajectory chart. What is this that we're looking at, and how is it important for framing up options trades?
Yeah, this shows on the same chart what the price of the stock in question could do over the next few days, either depending on its typical historical behavior, which is the orange curve. It's the distribution of returns, the historical distribution of returns. And the green line is what it could do due to the fact that tonight it's going to release earnings. Okay, so if you look at the values in the pop-up, if there weren't earnings, what you could expect with the 90% probability for Meta over the next couple of days is that the price could stay within 672 point something and 734 point something. But
Yeah.
due to the fact that our earnings coming to play, the range could be significantly wider. So you have to consider for 625 and then 810, which, by the way, are the two extremes of the short strangle we were looking at in the previous slide.
Yeah, so this is a helpful way to think about things, and that is that if you're going to sell options premium going into an event, then you need to understand how the underlying stock behaves during events of that type.
Yeah.
So there are, the most common events for publicly traded equities that investors are going to concern themselves with are quarterly earnings report releases. So every publicly traded company in the United States has to release an earnings every quarter. So you're going to have that 4 times a year. Now there can be other events as well. So sometimes retail names might release sales updates monthly. Of course, there's also corporate actions which may not be foreseen. So you can have events that will violate. So if the orange lines here represent how Meta would normally behave absent an event, and the green lines represent how Meta would behave around earnings, it is important for people to understand that there are always idiosyncratic events that can take place, things that come out of left field that are not going to be baked into these types of things. So, for example, and this is not the case for Meta, because it's just a huge company. No one's going to come in and buy out Meta. But if it was a much smaller business that you were looking at, and you were looking at it this same way, you do get those kinds of events. Yesterday it was either yesterday or the day before, we had an announcement that there's going to be a big merger in between 2 big U.S. rail companies. If a company is being acquired, that's the kind of thing where that's an idiosyncratic event, and that's also going to be reflected to the extent that these probabilities are, if you're looking at an 80% probability or 90% probability, there's always some chance that it's going to fall outside of these probabilities.
Absolutely.
But we're using these as a statistical approach so that if you do a lot of trades, and you take this approach that you have a diversified portfolio, you do a lot of trades. The more trades you do, the more likely that your performance is going to adhere to the statistics that are represented here.
Exactly.
Rather than just doing a single trade and saying, did it work or did it not? Okay, so I think you have one. Yeah, I think maybe now that we've gone through this at sort of a high level, we can go through Qualcomm now, but we can just go through it a little bit more quickly.
Yeah, sure.
And you can just describe the whole thing, sort of soup to nuts or start to finish, if you will. Beginning with Qualcomm. So starting with that earnings history report, and we'll kind of punch through this one a little bit more quickly, and then get some wrap-up thoughts.
Well, yeah, we can be very quick here because once again, if you look carefully, you will see that the expiration price has almost always been included completely within the lower and upper bands based on 80% probability. So the upper and lower bands that you can get with the trajectory chart are usually a very good measure of a price range within which the actual price of the stock is going to move. So you can use them in order to set the strikes of your trades. That's it. Mm-hmm. Okay, and again, if you move to the theoretical versus historical probability distribution chart, what you will see is that in the case of Qualcomm, the tail events are very, very rare.
Yeah, that's interesting. Look at that.
Yeah, look at that. About 90% of the events are within the extremes that come also from the theoretical distribution, the normal distribution. So what you could expect is that with strategies like short strangles, short straddles, vertical spreads, credit spreads, the probability to lose money should be very, very low if you pick the strikes properly, of course. Mm-hmm. And the options overview report, once again, according to the maximum pain theory, gives us a view of what could be the extremes of the movement. The average strike of the calls is 167.20, and the average strike of the put is 142.99. And as you can see, there's 17,740 calls open and 26,609 puts, which are both very, very good numbers, okay, compared to the volumes traded, the open interest on other expirations. The only one higher is the one of the monthly, expiring on the 15th. So once again, with all the limitations of the idea of this weighted center of gravity, this gives us a range we could expect the price to move within. Also, in this case, the option sentiment rate is quite neutral, is 0.97, not significantly far from 1. So what we could expect is that not big moves could be forecasted on the stock, on Qualcomm.
So here you're looking also at a short strangle then?
Yeah, another short strangle, 147, 180, again, coming from the trajectory chart. And here we have all the probabilities above 90, but the earning probability, which in this case is 74, which usually for me is a red flag because especially given the fact that the stock is going to release earnings, having an earning probability. Earning probability is what the stock could do depending due to the fact that it's going to release earning tonight. Okay. 74%.
Yeah, I saw it. If we could just go back to that for one quick second. So that's the number in the lower right-hand corner. That's 74.
Yeah, earning probability.
So now I heard you mention when we were going over Meta, when we were first talking about this, because I was asking, is 80% probability kind of the magic number that you found to identify enough trades and still get a good risk-adjusted rate of return? Is this related to that number in some way? Is there a reason, though, that this strangle's still pretty good with a 74, or am I not looking at this quite the right way?
No, in this case, having a value so different from all the others is something that should make us think whether this could be a good opportunity or not, because 74 is too low in respect to all the other readings.
So yeah, I'm looking across the bottom here, and I see basically very high readings across the board, and that, in essence, when you are taking this approach where you have all of these different models to calculate the respective probabilities, what you're really looking for then is essentially consistency. So you're looking for high numbers, but you want consistently high numbers across all of the different statistical approaches to understanding essentially how high or low the stock could go over the forecast horizon that we're observing in this case. Is that right?
Exactly. And by the way, as I said previously, I basically trade 95% of my trading is short puts on stocks, which I wouldn't mind to be assigned if the price dropped. So usually when all the readings are at least 80%, 80, 85, even better, if I pick the stock well, I'm not very concerned about what might happen. Okay, of course, not being assigned is better, but if I am assigned, it's something I can manage. Okay.
And if you do get assigned, is your normal course then to use this same approach to sell covered calls against the stocks that you are assigned on? Is that typically the approach that you take?
Yeah, usually I sell covered calls. If I really believe in the stock, I could also sell another put with a lower strike price, so that I create a channel for the price to move within, and the longer it takes for the price to recover, the more I will collect premiums on both sides. So I'm not afraid of it.
So in terms of position sizing then, would it be reasonable to say that you typically will sell puts on, a portion of the stock that you would be willing to begin to get into a position, but where you would have additional capacity? So let's just say, for the sake of argument, to keep things simple, that it's a $100 stock, let's say, and you'd be willing to potentially get long $20,000 worth. you might initially just sell one put, so that you would be put $10,000 worth, and then if you are put the stock, you would then maybe sell strangles against that,
Yeah.
another one lot, so that you could potentially get long another,
Yeah.
100 shares at a slightly lower price, and then called out of your 100 at a higher price like that. Is that a good way to think about it?
Exactly.
Uh,
That's how I do it
okay.
usually.
Okay, so then why don't we just quickly punch through then the expected trading range, what you're calling the price trajectory, and also the earnings history.
Yeah, as you
in
can see,
Qualcomm's case.
the price trajectory is consistent with the trade I created in the previous slide, 147, 180, because that's the two extremes of the price trajectory chart, which according to earnings is between 147 and 178, with a 90%
And
probability.
mm-hmm. And this one is the which chart are we looking at now again? This is the
It was the option sentiment.
this is the sentiment. Yeah, this is
Yeah,
the
the
sentiment
sentiment
one.
rate.
Yep.
Yeah, we already discussed it, I believe.
Yeah.
The 97.
Okay, well, this has really been quite informative, and I hope we get an opportunity to do another video where we can delve into some of these statistical models
Sure.
and concepts in greater depth and detail, because I think people might find this really quite interesting. But what I like about it is that there's a lot of data and a lot of different statistical approaches that are being distilled into, basically some relatively simple numbers. You get you get some ranges, expected trading ranges, and some probabilities that you can use to frame options trades. And I'm supposing that this kind of approach could also be used theoretically, for people who are trading debit spreads and things like that, if they wanted to. I mean, it seems like its best utility is probably to identify high probability credit trades, but it also gives you a sense of the likelihood that even debit trades are likely to pay off or not.
You can do it. Yeah, there's a section of the platform which is called Trading Ideas, which provides ideas based basically on short puts, iron condors, credit spreads, and debit spreads. So depending on what
an investor's preferences.
Yeah, exactly. What kind of trades you'd rather take, and yeah, you can always find some good ideas.
Okay, well, Domenico, thank you very much.
Thank you, Mike,
for joining us. I've really enjoyed our conversation today. Recover quickly from your cold, and then hopefully you can join us, and we'll go over another one of these and come up with some other interesting ones. These were actually actionable trade ideas, which we love. If there's ever an opportunity where we have upcoming events and we can give people some ideas based on the best data available, that's really helpful. So thank you very much. And thank all of you for watching. Like, subscribe, hit the notification bell. And if you have any questions for Domenico, or for me, frankly, for both of us, or you're interested in this approach, want to learn more about it, put those into the comment section for this video, and we'll try to address them in a future video when we get Domenico back, which I hope will happen very soon.
Sure.
Thank you all for watching.
Thank you. Bye.